when I buy a miner, I'm thinking like, I want to buy a central bank, and then maybe bequeath it to my kids when 10, 20 years from now, when this is all over, and it will definitely be over 10, 20 years from now. I have no doubt about that whatsoever. I want a piece of capital that produces money, because at the end of with this end game, I don't think we're going to go back into fiat. I don't think it's going to be possible. We're going to have to deal in gold and silver for as long as it's going to take to rebuild trust in some kind of credit derivative of gold and silver. But it's not like people are going to immediately go back to paper, because like, look what just happened. It's going to take a long time, and in that time, you're going to want to have companies that can produce gold and silver and pay you dividends in the money that's going to be for the world at that time. I don't know exactly, but what I would guess is a big part of it is I just, right, like maybe a minute or two before we started the interview, I was looking at Yahoo Finance, and a lot of the head articles are like, the Fed is worried about this Fed member is talking about that, changing the benchmark interest rate, or how they control interest rates, or what interest rate to target. It's like the Fed FOMC board, or whoever votes on it, they're usually monolithic, and they all say the exact same thing to the media. It seems that they're starting to get a little bit frayed, and there's starting to be a little bit of independent thought, like, independent thought alarm. Everybody start worrying about the dollar. Like, when the dollar is run by a bunch of central bankers that have different ideas and they're all getting nervous, then that's when the dollar is shaky. It's it's a coincident indicator. It's not leading or lagging. It's like when the central bankers get nervous, the dollar is getting a little bit shaky. And if you want to do an interesting research project, I've done this before, look into the Federal Reserve website, and they have old transcripts from the 1970s and early 1980. They have transcripts word for word, not the minutes, they have the minutes too, but every word that was said, dialogue between Volcker and his little minions, what they were saying. They were like nauseous in late 1979, early 1980. They had no idea what to do, and they were all freaking out and asking Volcker for leadership and just to calm them down. So that's what the Fed is stepping into now. They are forced to cut into an accelerating consumer price inflation environment, and this is making them nervous because they know it can't work. But there's nothing else that they can do, because if they don't, the banks are going to collapse, and if they do, the dollar is going to collapse, and they're headed into that choice now. That's where they're going, and they know it, and they're getting nervous.
The Fed faces a no-win choice: raise rates and risk breaking the banking system, or cut rates and risk collapsing the dollar. Inflation remains stubborn, especially in services and housing, while wage pressures continue. Policymakers once promoted symmetrical inflation, allowing prices to rise above target after years below. That idea has vanished. The public no longer tolerates higher living costs, and political pressure is mounting. With limited policy tools, the Fed is running out of excuses. For ordinary Americans, this isn't abstract theory. It's shrinking savings, rising credit card balances, and higher everyday costs.
They used to talk about something called symmetrical inflation, where you try to get it above because it's been below too long. You haven't heard that word come out in the last few years. I haven't heard anything about symmetrical inflation at all. This takes me to they're running out of academic excuses because they know that people are suffering. I mean, the rank and file, average Joe type of American is not going to have that much savings, and he's going to be really hurt by these price increases, and they are being hurt. And there's really nothing the Fed can do about it right now. And since they're out of their techno babble, macroeconomic, econometric excuses for what's going on, this is where things get visceral and things get a little bit scary for them. And, with Trump on the attack also, they're being attacked from that direction. I'm not saying the attacks on them are good or bad. It's just, I wouldn't want to be a central banker right now. I kind of feel bad for them, but I don't. It's like when your enemy finally gets his comeuppance and you've been thinking about it for a long time. When you see it happening, it's like, it's not so nice, but there's nothing you can do. But you're on the other side, and that's good. And you made the right choices, and now you just have to live with watching other people fall, including central bankers. And all right, I enjoy it with like maybe like 5% of my, Schadenfreude type of personality, but mostly it's just sad.
Behind the scenes, the plumbing of the financial system is under strain. Every night, trillions of dollars move through the repo market, where banks exchange cash for treasuries. Currently, about $2.9 trillion trades daily, yet Fed officials claim only 2.7 in reserves are adequate. The math doesn't add up. At quarter end, repo demand spikes, often pushing borrowing costs far above the Fed's target. This echoes the repo crisis of 2019, when short-term rates surged unexpectedly. With reverse repo balances nearly depleted, the system lacks a cushion. Another liquidity shock could arrive sooner than markets expect.
I'm not even sure the Fed understands this. It's a matter of basic arithmetic. It's not that complicated. I see these articles over and over, like they're saying, like, what's the amount of reserves that is ample or appropriate for the banking system? Well, it used to be zero because the repo market wasn't really a big thing. But then once 2008 hit and they had to buy all this dead debt, and then all that dead debt turns into reserves, which they have to keep cycling through to keep the balance sheet big. So you have all this ghost debt that can no longer be paid back, but it like lubricates the pipes inside the main aorta of the banking system. So the basic arithmetic goes like this. It's that there's like $2.9 trillion being traded every night between banks for reserves in exchange for treasuries. And then you come out and one of the Fed members said, well, I think the appropriate number for reserves is 2.7 trillion. I don't think we're going to hit any problems until 2.7 trillion. But like, I look at that, I'm like, seriously, you're going to like say that in public, 2.7? But then what about the 2.9 trillion that are being traded every night? Like, how does that work? How do you trade $2.9 trillion every night with 2.7 trillion in reserves? This doesn't, the math doesn't add up. There's $200 billion missing. So what do you say to that? Like, either they have no idea what they're talking about, or you can trade more than the amount of reserves in the system every night through some kind of mechanism that I've never heard of and I don't understand. Maybe. I don't think that's going to happen. But the point is that reserves are now like 3 trillion, almost 3 trillion flat, because the Treasury has been raising a bunch of dollars and they get that from bank reserves. And reverse repos are now basically zero, so nothing can come from that box of money back into the bank system. It's pretty much empty. So, when we hit September 30th, which is only 5 days from now, when repo generally spikes for whatever regulatory reason that it doesn't even matter, but it does every quarter end. So we're probably going to have repos above $3 trillion in volume with reserves below that. So what happens is that you have to bid higher for repo cash, higher than they want to control interest rates for. So that's what happened in the repocalypse. That's what I think is going to happen now. If you have more repo trading volume than you have reserves, I mean, there could be a mechanism I just don't know about, some kind of magic money box that exists somewhere that I never heard of, but that's what I think is going to happen. I think interest rates are going to go up next week.
The U.S. dollar remains the world's reserve currency, but its dominance rests on fragile foundations. For decades, countries battling hyperinflation stabilized by pegging to the dollar, Argentina most recently. But what happens if the dollar itself falters? Unlike past crises, there's no larger currency to fall back on. The dollar is the top of the pyramid, the ultimate derivative of trust. If it cracks, global finance has no backup. History suggests the fallback would be gold, the only universally recognized store of value. Such a transition would be sudden, not gradual, and deeply disruptive.
When you say duped, I don't think that people get duped and you convince them, and like some speech by some politician on CNN or whatever convinces them, oh, we're going to try this credit derivative and it's going to work. It's not that people get duped in that way. The dollar built itself on many decades of legitimate commerce in the 19th century and early 20th century. and it was convertible. You could go to any bank and get your gold for your dollars, and there were problems, but they weren't as big as now. So, for example, when Germany and when Weimar was, let's say, duped by the Rentenmark, they weren't, because ultimately it went back to dollars, and through some kind of derivative chain, the Rentenmark was saved by the dollar. But when you're talking about the dollar itself falling, there's no other derivative to build a system on, because that is the base credit derivative, again, reserve currency. When that falls, it's not a matter of not being able to dupe. If you look at the pyramid and then you take out the second layer of it, what are you possibly going to build a credit derivative based on? What? It can't be the dollar. It can't be anything else. It would have to be gold. So you'd have to have a currency that has been traded convertible to gold for long enough that people would actually say this is a convertible currency, because people are going to be so sick of paper money and derivative money, derivative credit for after this goes to hell. They're going to be sick of it. And they're not going to want to go back until I would say a full generation, maybe 20 years, that we're going to be trading money. And that's really going to slow things down, and it's going to change life as we know it. I think it'll be okay, but it'll be very different from what we know now.
If fiat money credibility erodes, tangible assets will become central once more. Gold and silver, once sidelined, would again serve as the basis of trust. But this isn't about short-term price speculation. It's about endurance. For investors, mining companies represent a form of private central bank, producers of money in whatever system emerges next. Dividends paid in precious metals could outlast any paper promise. As history shows, after currency collapses, trust in paper doesn't return quickly. A generation may pass before people accept credit derivatives again. Until then, gold and silver could define global exchange.
All fiat currencies today are based on the dollar. That's when any country hyperinflates, what do they do to restabilize themselves? They repeg to the dollar. That's exactly what Israel did in 1985. It's exactly what every hyperinflating currency does. That's what Argentina is trying to do right now. They just did a $20 billion currency swap. That means that pesos are backed by dollars. That's what it means. That's a currency swap. This is how the dollar prolongs the hyperinflationary process in every country. But there's nothing that can prolong the hyperinflation of the dollar itself, except for the fact that it occupies that space as the reserve currency. That's the only thing that's stopping it. But once that goes, everything happens very fast. What exporting inflation does is it delays the inflation. When I say inflationary, I mean rising consumer prices. It delays the effect on rising consumer prices because you're exporting all those dollars outside your country, but they're still there. And when they will be sent back, because China doesn't use dollars. They use yuan. That's their currency. So they have no direct use for dollars within their country. So then when the dollar is losing value, the best they can do is send it back to the source. And every country will do that at the same time. So yeah, all of the delayed inflation that the United States never experienced all comes to its door in a sudden flood of reversing the whole reserve currency situation. Has to be reversed, and it's not going to be gradual. It's going to be very sudden.
The transition away from a dollar-dominated world won't be smooth. Inflation shocks, liquidity shortages, and political battles will test institutions and individuals alike. For households, this means rethinking wealth not just in terms of dollars, but in real assets and long-term resilience. For policymakers, it's a moment of reckoning. Exporting inflation abroad worked for decades, but now those dollars are flowing back. Once confidence breaks, the shift will be rapid and irreversible. The Fed may not fully grasp it, but arithmetic is destiny. Debts must be cleared, currencies must reset, and trust must be rebuilt, likely in gold.
I would say just forget about the dollar amount. Don't use mining stocks as a way to increase your dollar stacks. The reason I hold mining stocks is because, first of all, I don't want to have only bullion. That makes me nervous because I don't know where to put all of it. I have enough for what I think will get me and my family through the end game. That's all. In a modest way where I'm not going to be ostentatious or anything. I have no desire for that. It would be dangerous and also insensitive, and it's just not my personality to do that. So, where am I going to put anything that I don't need for the end game, for end game needs? I would put it in a company that I know can pay me dividends in a new monetary system. So when I buy a miner, I'm thinking like I want to buy a central bank, and then maybe bequeath it to my kids when 10, 20 years from now, when this is all over. And it will definitely be over 10, 20 years from now. I have no doubt about that whatsoever. I want a piece of capital that produces money, because at the end of with this end game, I don't think we're going to go back into fiat. I don't think it's going to be possible. We're going to have to deal in gold and silver for as long as it's going to take to rebuild trust in some kind of credit derivative of gold and silver. But it's not like people are going to immediately go back to paper, because like, look what just happened. It's going to take a long time. And in that time, you're going to want to have companies that can produce gold and silver and pay you dividends in the money that's going to be for the world at that time.